Good morning, everyone. My name is Damaris Mukulu. I'm the head of brand marketing and communications at Genghis Capital. Welcome to the Genghis Weekly Investor Briefing. The Genghis Weekly Investor Briefing is an initiative by the research team that compromises of Melody Danu and Wesley Manambo. So Melody and Wesley today will be walking us through the fixed income and the equities markets in Kenya. The goal of the webinar is to give you insights to what happened in the markets last week, as well as what we foresee that's going to take place this week, as well as share any trading recommendations they have both for treasury bills and bonds, as well as for stocks listed on the NSE. The webinar is interactive, so please feel free to use the Q&A tab that's either at the top or bottom of your screen, depending if you're using a laptop or a mobile device to join us today. At the end of their presentations, Melody and Wesley will be able to answer any questions that you have that are related to the financial markets. We hope you'll find this brief session engaging and useful. So without any delay, over to you, Melody, to kick us off.
Thank you, Damaris, and good morning. Just a second, I share my screen. Okay, so we'll be taking you through what's happened majorly in the macro. Then we go to the equity, fixed income and equities. So starting off with the macroeconomic review. So the government had released a gazette statement where it outlined its revenue collections for the month of August. So we saw
Melody, I'm sorry to jump in, but your screen sharing hasn't come up yet. Maybe you could attempt to do it again.
Okay, give me 1 second. Looks like it's one of those days again.
It's okay. I think you can just soldier on, and then hopefully at some point your screen will show up on this on ours as well.
Okay, so as we wait to, okay,
Wesley, I see you've come onto the call. I think Melody's side is having internet issues. So could you hop in? I'm sure you'll be able to share your screen on top of hers. You can unmute and help out.
Okay, I have some issues. Monday mornings and Horizons from my end has issues. Can you share the screen, your screen if you can, then I try pick up from where she left.
Okay, no worries at all. I think at this rate, our participants are accustomed to our glitches. Okay, here we go. If you're in the office, Wesley, I would say it was the office-based individuals, but you're working from home and we're supposed to be leading examples. Don't worry, I'm opening up my PowerPoint, just a moment.
Thanks.
Okay. Okay, I'm here, enabling editing, and let me share my screen. Now, you let me know when you see it. You can see it?
Yes, I can see your screen.
Okay, so let me just go into presentation mode. We're good?
Yes, we're good. Oh, this is so out of my comfort zone, but I'll do my best. So from the Gazette statement, ordinary revenue collection for the month rose from 135.3 billion to 272.4 billion. That's up 34% year-on-year during the same period. Non-tax revenue soared to 3.5 billion, up from 352.9 billion in FY20, FY21 as the economy recovered. Non-tax revenues are generated non-tax revenues generated include royalties, fees from mining rights, dividends on government investments in state-owned enterprises and in stock portfolios. Also, sovereign wealth funds and government shares in joint ventures with private operations make part of this. Also, this outturn in revenue performance could be due to the tax measures introduced this year as tight administrative measures were enforced. The Kenya Revenue Authority was dealt a blow last week with the High Court banning the collection of minimum taxes from businesses.
Sorry about that.
Thank you. Please carry on. Or I continue.
Where had you reached?
Just about to get to the diaspora remittances.
Okay, I think I can assist from there.
Thanks.
So looking at the diaspora remittances, they had gone up by 14.1% year-on-year to 312.9 million. However, it had a decline of 7.1% from the previous month. So this one was mainly attributed to by the central bank due to seasonality. So also the contributions dropped from US from 58.3 in July to 46.8 in August. So we know that these diaspora remittances are an important source of foreign exchange income, seeing that we've seen also tourism, the numbers have been quite low. But now with the Kenya off the red list, hopefully the numbers of passengers and travelers will pick up again. Though it's not in the presentation, a parliamentary committee last week recommended the rejection of a creation of a special fund, which was supposed to ring-fence money, cash for repaying mature debts, and also paying off mature loans, buying back bonds when the prices are low, correcting any mispricing in the yield curve, and it could have helped in avoiding high costs in the future. So currently at the moment, debts are paid from the consolidated fund services. And the reason why they recommended a rejection is because they said that it didn't have sufficient public participation. So it's now been tabled before Parliament so that they can debate and approve. So in the secondary markets, the activity was relatively flat, which was about 0.4% rise week on week to 39.7 billion. So mainly interest was towards the infrastructure bonds, as we've seen in the previous weeks, as well as the 20-year segment. So people are focusing more on the longer tenured bonds. So this week, or rather last week, the central bank announced its coming bond issuance, where it's going to reopen some papers. That's the FXD123, which has an outstanding tenure of about 6.4 years. FXD3 2019-15 has an outstanding duration of about 12.9 years. And FXD1 2021-25 has a tenure of about 24.7 years. So here they want to raise about 60 billion, which is said is for budgetary support. And we noticed that this comes as the government is going ahead of its borrowing curve, and it might actually push the amount of debt collected this month, or rather this financial year, to get to about 50%. So this performance of this sale mostly will depend on the liquidity levels. We've seen that it's been a bit tight this last week and the week before, mainly due to as early cycle balances, with banks trying to fulfill their CRR requirements as well as tax settlements. So just maybe a side note, so a reopening is where like new securities with the same tenors and conditions have this, rather the government is opening an existing issue, and this will increase the size of the outstanding amount. So it has the same maturity, the same coupon rate, and the only difference now will be the issue date and also the price that will be related to the yields. So the maturity, as we've seen, is quite varied. So I think the government is looking for a way to entice people who are interested in both the long end of the curve as well as the short. We've seen that there's one about 6.4 years. So for T-bills, the demand was again low. Performance was at 42.3%, down from 56.4% the previous week. And before that, it was about 70%. So we've seen that performance has been going down. So the amount of bids that were received was 10.2 billion against an advertised amount of 24 billion. So the yields went up just an average of 3 basis points week on week. But however, we noted that if this is going closer to the rate, the psychological rate of 7%. So moving on to the next slide, the market liquidity. So it's been tight this week, as evidenced by the 200 basis points jump in the interbank rate to go to about 6.14%. And we've seen that this is most likely due to corporates settling their tax obligations before the 20th deadline, and as well as the government having higher receipts than payments. So looking at this strained liquidity, the CBK came into the open market operations to inject liquidity via 7-day repos. So the amount that was, the bids received were 57.8 billion and accepted was 35.4 billion at a rate of 8.27%. Looking at government borrowing, it's estimated to about 265 billion, including the overdraft, which is about 41% of the yearly targets. Moving on to the next slide, just looking at, before I look at the macroeconomic calendar, just a side note that Shelter Afrique, which is a Pan-African housing developer, they said that they fully paid their commercial debts and are now planning on issuing new regional bonds. So in East Africa, they are looking to raise about 55 billion, and it's most likely that it will be listed on the NSE, but it will be open to regional investors as well. So we might see some increased activity in the corporate bond markets. We saw also Family Bank had listed their bond previously. So we're seeing some activity in the corporate bond segments. Also, Econ holders, they're looking to get about 1.4 billion from additional from their bond holders. So this is so that they can extend from the current term note from 5 billion to 5.7, and also the previous issue, they were a bit below target, so they're going to add on to that. And they've also transferred the liabilities from the partnership to the D rate, that's the development rate. So once the construction is complete, they might move this now to the I rate, where it will be, where investors now will have the choice to either invest the funds, to sell, lease the shares, or they can choose to sell the developments that have been undertaken. So looking at the calendar, 28th of September, we're going to have the Monetary Policy Committee meeting. And from our view, we expect that it will be held at 7%. So mainly this is just because we expect the inflation to remain between that range of 5 plus or minus 2.5%. However, inflation, as we're waiting to see the inflation numbers this month, we expect that they're going to be higher, mainly due to the rising cost of food, the rising cost of fuel, also the rising cost of electricity. So we also note that the IMF had put some, you can say, targets that Kenya's inflation should remain against a certain range that the CBK has provided, so that we can continue as a country accessing the loan that was availed. So they're going to do a test and evaluation in December 2021. So by then, the CBK will have to look at the rates, and if there's any adjustments that need to be done, they can do it before then. And also 30th September, we are waiting for the inflation rate figures. And as you said, we're expecting some upward bias. Also, another fact is due to the base effect. If you compare inflation the last year and right now, you're going to see a big difference because of a disinflationary trend last year. So looking at the next slide, the trade of the week. So it's still on the IFB 2021-21 at 12.4 to 12.45. So just looking at the coupon rate, it's at 12.74, which is tax exempt, vis-a-vis fixed rate bond, which has a longer duration that requires the payment of withholding tax. So just looking at FXD1 2021-25, it has a high coupon, yes, at 3.92, but you have to consider the effect of tax. So after tax, the coupon rate is actually 12.53, which is lower. So we might see some activity in both the buy and sell, some buy and sell activities from investors as well as banks try to exit to free up the liquidity, as well as retail investors now trying to get into the opportunity. I think I'll hand it over now to Wesley to take us through the equity portion.
Thank you, Melody, and a good morning to you once again. Investors with bearish sentiments drove the market as signaled by the benchmark indices performance. The Nairobi All Share Index dwindled 2.7% week on week to settle at 177.81 points, and the NSE 20 Share Index shared 1.1% week on week to close at 2039.75 points. That said, market turnover grew 31.8% week on week to a turnover of 3.22 billion. Nairobi Business Ventures led the pack of the week's top performers on a 10.8% week on week rally. Standard Group, Jubilee, HF Group, and Everready gained 8.7%, 5.3%, 4.1%, and 3.96% week on week respectively. The uptick by NBVs on the back of its AGM resolutions on securing acquisitions by an issue of 857.7 million shares of the 1 billion shares to be created. Also, the news of breaking ground for the cement plant is expected to fuel a near-term rally. We'll see this in a short term as we dive deeper into the AGM resolution. Crown Pens led the week's laggards, shading 16.25%. Unga Group, East African Portlands, Equity, and Can General shared 9%, 6.8%, 5.2%, and 4.9% week on week respectively. Equity's price function has an aspect of mean reversion tied to it, which rudimentary points to a statistical argument on prices tending to converge to their historical average over time. Mean reversion is a universal truth in times between and after corporate announcements and results release, when investors' action are primarily driven by portfolio recalibrations and speculation. Most people tend to see it as some form of price correction. As a side note, investing ratios like the price to book ratios and the price to equity ratios effectively buy into the notion of the mean reversion, and they project a counter as overvalued or undervalued based on either their industry average or cyclical adjustment ratios. The arguments they present are simply based on time series or cross-sectional analysis of past performance, which has the aspect of mean reversion. So mean reversion is such a key thing. And also conclusions in market analysis like Jeremy Siegel's work that pointed to stocks having a higher return than other asset classes, they carry the sentiments of mean reversion in such a big way. Also, the interesting fact about mean reversion is how it holds water for as long as historical patterns reoccur, and when it doesn't, then notions like the momentum-based strategies kick in, arguing that stocks with potential to grow will continue to grow regardless. But that's neither here nor there. Looking at the foreign participation, foreign investors accounted for 45.5% of the week's turnover. They veered from bullish to bearish with outsized exits in EABL and Safaricom while accumulating on KCB Group, Equity Group, and Jubilee Holdings. When we were having some thinking on this with Melody, she pointed out something that I found interesting. She pointed out that the US Federal Open Market Committee retaining their Fed fund rate at 0 to 0.25 was a significant factor in the week's foreign participation as foreign investors become more confident in their home markets. Now, looking at NBV, there are AGM highlights. The directors of the company were given authority to increase the nominal share capital of the company by creation of 1 billion new ordinary shares with a par value of with a par value of 50 cents, which rank pari passu to the existing ordinary shares of the company. That means they rank in equal measures to the existing ordinary shares. Of these, 442 million will go towards 100% acquisition of Delta Cement. 31.3 million will go towards securing 100% of Air Direct. 123.1 million will go towards 100% acquisition of Aviation Management Solutions Limited, and 260.8 million will go towards securing 100% acquisition of Delta Automobile. In total, the transaction will see the transfer of 857.7 million shares to Delta, which will increase the stake from 84% to about 94% there also, give or take a bit. As an out of consensus view, the counter is speculated to have its support level cemented at the transactional value of 4 shillings, and a near-term rally is expected following these announcements and news of breaking ground in its Mavoko cement plant before the end of the year. Looking at the sub-Saharan market performance, the Nairobi All-Share Index dwindled below its peers on a week-on-week median comparison. The market's price to earnings ratio was above the African median multiple of 9.4, with its dividend yield, while its dividend yield was below the African median by 200 basis points. On the corporate calendar, we have Centum's 33 cents first and final dividend with a book closure of 8th October. To you, Em.
Thank you, Wesley. So just going to look, before I look at the financial sector highlights. So for the Fed to retain the rate, so some people are bullish, they were thinking that it might change, but they also noted that as the economy continues to grow, they might start the tapering process, where they'll start slowing down on the quantitative measures that they put in. And now investors now will shift their funds from the emerging markets to now invest in their own markets because of the confidence that the economy is growing. But thank you also for highlighting that. Looking at the financial sector, so both the banking and insurance sector counters had mixed movements in the week. So the top gainer was HF Group at 4.08 shillings at the end of the week, a rise of 6.3% week on week, followed by ABSA at 10.55 shillings at the close of the week, a rise of 1.9% week on week, as well as I&M, a marginal 1.5% rise week on week to 23 shillings. Equity was the laggard of the group, with the prices falling 4.7% week on week to 50 shillings and 50 cents, followed by KCB, a drop of 2.6% to week on week to 41.7 shillings. Looking at insurance, Jubilee went up 5.4% to close at 368.75, and Sanlam as well, closing at 11.9, which is a 3.5% rise. Liberty and Britam shared marginally to close at 8.14 and 8.08 respectively. So Britam last week, they launched a new product for retirees. It's a medical plan. So it's supposed to enable retirees to save towards purchasing medical insurance after retirement through pension schemes. So it's supposed to offer tax efficiencies and investment returns, as well as flexibility to transfer funds in case of change of employment. So we saw even the week before, CIC had introduced a medical cover for senior citizens that was going to go as high as 80 years. So we've seen now that insurers are looking towards the older generation, rather than retirees, to diversify their revenues. Of note is that there was a report that stated that about 77% of pensioners had the insurance cover mainly from NHIF. So usually the retirees are viewed as, the older age is usually viewed as risky. So we're going to see how this new strategy plays out. For Cooperative Bank, they signed a deal to boost green financing for SMEs. So it was a loan portfolio guarantee agreement with Africa Guarantee Fund for SMEs. It was amounting to 750 million shillings. So this, because banks find that the assets rather, that it's not easy to liquidate them in case of defaults. So that's why now this came about, to give Cooperative Bank the confidence to lend to SMEs that use these solar energy sources. So we've seen that this year some banks have been receiving loans from international institutions to lend to SMEs, as well as to strengthen their capital base. So they raised about 97.5 billion in total. That's equity, KCB, COP, and I&M. So the only thing now is banks actually have the burden of proof to show that they're using this money to actually support SMEs. So we're going to wait and see how that pans out with the results that come out. We see if SME capital, rather credit. Then lastly, Family Bank opened an Isiolo branch. So they're expanding their outlets to now stand at 93. So this is part of the lender's medium-term expansion strategy. So it raised the bond, as I mentioned earlier. It raised about 4.4 billion. So this bond, they had issued it to strengthen their capital base, as well as for onward lending to SMEs, who form about 80% of Family Bank's customer base. So they say that this branch is going to present opportunities, mainly from tourism, as well as current and planned major infrastructures projects. So for the trade of the week, we're going to, we suggest a long-term buy for Cooperative Bank, seeing that they signed this financing deal. They're diversifying their products and their lending to SMEs, and this is going to boost, or we forecast, or it's in our opinion that it's going to boost their revenue sources. We saw also earlier in the year they had mentioned that they're launching pension-backed mortgages. So we can see that this diversification in products, we anticipate that they're going to diversify the revenue and commissions earned by the bank. Also, it's currently discounted, trading at a price-to-book ratio of 0.84, which is lower than the industry median of 0.97. Also, CoBank has traditionally been paying dividends, so this would be more like suitable for people who are income-oriented investors. I think that comes to the end of my presentation.
Okay, thank you so much, Wesley and Melody, for for your presentation. We have a couple of questions that have come in. Let me start with Sean. Sean was asking why equity has had a bad week. He's referring to last week, and I think he's referring to Wesley's presentation.
I can attempt, then Wesley can answer. So basically, we've seen that due to price correction, people were very optimistic about the counter after the results were released, which were very good, almost a 90% jump. So now the market has kind of come down from that news. And we haven't seen any other market moving news that we can see that has actually affected the price. So we can just chalk it down to price correction.
Okay, all right then, thank you for that. Samuel appreciates your discussion on the Fed rates. So he says very insightful on the Fed rates correlation to net outflows. If I move to the Q&A tab, before I come to his other question in chat, there's 2 questions on the Q&A tab. Kamau is asking, or rather commenting, Melody predicts an upward bias against inflation, meaning eroded purchasing power. Which counters will be most affected?
So for that one, I wouldn't say that there's any specific counter that would be affected. But we had noted that there was the issue of price increase in fuel, as well as things to do with alcohol. So we might see counters like EABL or Total. Maybe we can say that those ones may be affected. But generally, I don't think that the inflation will have a direct hit on the prices of counters.
Okay, all right, understood. Someone has a question about last week's news about Chris Kirubi's Skin, who are going to acquire the 2.1 billion worth of shares. He asks, do you posit that centum shares are undervalued by the market?
That's a tricky one because we haven't really valued centum shares. But according to the company, they say that the stock is deeply discounted, mainly because they believe that the market doesn't really know how to price them, and also because of the high risk due to the high financing costs that they had before. And now that they are looking into ways of how to generate more revenue, as well as they had previously mentioned that they might sell the centum re, which deals with the real estate. So for me, we haven't really looked at the counter to value it, but looking at its price to book ratio, it's showing that it's deeply discounted, as well as the firm's net asset value that they had given, that shows that the value is about 60 shillings. Maybe Wesley can add something on that.
You've touched on the basics. Also, as Melody says, it's quite difficult to value this counter because there are a lot of moving parts. And if you value let's say the private, when you value this company, they make most of the profits from exit. So if you want to see how much value that exit could be, you have to value the underlying company, and they have several underlying companies. And by the time you reconcile all that data to the current news, you find, oh, so many things have changed. So there are a lot of moving parts to the counter, which makes it quite a task to. But yes, the counter is, according to the company, the counter is undervalued, and looking at the PE ratios, for instance, and the price to book ratios, it really points towards the counter having more value to be unlocked in the future based on the historical performance and benchmarking it against an industry level.
All right, thank you guys.
Sorry, just wanted to add one thing. There's a time in the AGM they had approved the share buyback option. So we're going to wait and see if they're actually going to go ahead with that, which might cause the prices of the share to go up as well, because there'll be less shares outstanding. but it's just a wait and see.
All right, thank you for that comprehensive answer. A couple of questions that I can handle myself. Elvis is asking whether this recording will be on Facebook. It's currently streaming on Facebook. After the webinar ends, it'll be on the Genghis YouTube channel. So if you want to rewatch it, just find us on YouTube and search for episode 49. We have a playlist there for all recordings. Thanks for that question. I saw a question from Kavnish. He's asking how you can buy the Acorn right. Kavnish, if you are a Genghis client, I hope you're a Genghis client, I'd urge you to reach out to the client relations team on their email address, which is clientrelations@genghis-capital.com. They'll be able to assist you further. We have a question from Frederick. He asks, what's the outlook of Family Bank? And then I'd like to also add on to it. No, let's just tackle that first, about the outlook for Family Bank.
So I would say, in my opinion, that the outlook is quite positive. We've seen the results. They've been coming out from a loss-making territory and now are making profits. We also saw that they had the bond issue and it was very well subscribed, showing that investors are quite bullish about the company's prospects. So just a few of the drivers that I can say, I've seen that they have increased their lending to SMEs, and which is going to boost their net interest income, and they're also planning to roll out agribusiness banking. Another thing is also regional and local expansion. So there's been a note from this bond issue that there's going to be possible acquisition of a stake in a regional bank or microfinance bank later on, as they intend to do a regional market entry. And we see that this is going to diversify their revenue as well as grow the customer base. So as you've seen, they've already started. They are planning to expand its presence across the country, and it's targeting a tier 1 status in the next 3 years. And there were stories that it might be listed. It's not been confirmed yet, but it's a wait and see. Also, they've been investing in digital innovations. They revamped their PesaPap mobile app. They introduced the salary advance feature. And from this feature, I believe it's going to boost the income from fees as well as net interest income.
Thank you. With that, maybe we can move to housing finance, because we have 2 questions from Joseph and Norman. Joseph is asking what underlies the positive move by HF, and Norman is saying, what is the real performance of HF after adjusting for the current banking base effect?
So for HF, that one for adjustments, I'd have to come back on that one. But for the positive price movements, I believe it's just investors speculating, because we saw that it actually posted a loss. However, the amount of non-performing loans actually went down by a huge percent, about 20-something%. So it could be that people are still reacting to the bullish news about that. Also, there's a time that Britam had mentioned that they want to sell a percentage stake from the HF holding. So it could be that as well, but we haven't seen any movement in that news. So just in my opinion, I think mostly it's just speculation.
So the question about adjustments, are we going to look into it and perhaps address Norman's question next week?
Could you repeat the question for me again? That one for...
Sure. The question is, what is the real performance of HF after adjusting for the current banking base effect?
Yeah, that one I might have to get back. But the performance itself, we've seen that it's been making losses. So it's just to wait and see how they're going to turn around the business through their strategies. But you've seen, as we said, the non-performing loans have gone down. but the customer deposits and loans as well went down. So there's some mixed performance there. So for that reversion, I'd have to come back.
All right. Austin, we're very happy to see you. We got your email last week, and Melody and Wesley are prepared to tackle your question. So Austin's question, or rather he says, he's taken a keen look into the markets and noticed nearly all the companies that performed best in the period between 2013 and 2015, then a drop begins. He'd love to know why that is the case. Were there signals previously in the entry of 2013? And if there were signals, what were they?
Let me go first, then Melody will give her higher level thinking. So when you look at this time period, I'll tackle this question in two parts. First, the global environment, then the local environment, because given that majority of investors in the bourse are foreigners, events happening in the global stage have a significant effect to our markets, which we can't ignore. For reference purposes, as you've seen, the US Federal Open Market Committee retaining the Fed fund rate at 0 to 0.25 had an impact to the foreign participation we had in the past week. Now, looking at this specific time bracket, there were some significant events in the global stage. For instance, in 2015, when the global commodity prices fell, most investors hedged in fixed income assets, and that had an adverse effect in equity performances. Also, 2016, I tend to believe, is when Trump came into office, and the America First policy drive saw a significant reallocation of capital from frontier markets to the more mature markets, and that had an effect to our local market, since it's a frontier market. And then when you come closer home and look at the macroeconomic environment, it has not been that rosy. When you look at the legal and regulatory environment, for instance, we see the reintroduction of capital gains taxes in January 2015. VAT on petrol products has been on the rise, and that's just to mention but a few. In a way, also, the fixed income has become a safe haven for risk-averse investors with their lucrative interest rates, which tend to be more attractive given all these uncertainties in the equities segment. And then there was the two elections in the 2017 election cycle, which was not so good for risk-averse investors. And also, to conclude, the companies and industry unique factors have also had an increased diminished returns shy of the banking and the telecommunication sectors, which have been on a stellar run through and through. And the fact that the GDP has been driven by public investments as opposed to sectors which could lift the real economy, it also has an impact to how these companies operate, because yes, the growth is seen on a macroeconomical level, but then it does not trickle down to the sectors and the performance of these specific companies. So when you look at it from the global perspective and the local environment, yeah, it's something that could have been, yes, they always say it's not over until Amelia Martena sings. So you can't really say it's over until she sings. So let's say if an investor could have pointed out all these things, it could appear so far-fetched. But then as time happens, these things get solidified and they crystallize. Then, wow, we realize, so maybe that was a possibility. They saw it coming. So yeah, it was seen coming, but we couldn't put a timeline. This will happen in this period of time. And also, with uncertainties, it also means something could have happened and then the prices will have been up again. So Melody, I'm really waiting for your high-level thinking on the same.
I know Melody is having some sort of challenges. I saw her hop in and hop out, but I have seen her hop back in. Wesley, who was that opera singer again? For the rest of us, we just call her the fat lady, but you are being
she's called Amelia Martena. Actually, wow. I tend to believe the colloquialism. I think the colloquialism means it's a phrase that is not official, it's just coined. The colloquialism, it's not over till the fat lady sings, was coined, I believe, in reference to her. She was one of Richard Wagner's musical drama performers, and she really gave a stunning performance in one of her performances in the Ring Circle, I tend to believe it was called. And after she led that performance, she had so many other recurring roles in the musical dramas, and she became a regular in the Vienna state operas. And yeah, and I also tend to believe the description was more of a compliment, as it was a beauty standard in the days. So yeah.
Might need to add you to the Genghis quiz team. You know, quiz nights are coming, and yeah, so you're in the quiz team already. Thank you for that, Wesley. I can see Melody is here. So you did an excellent explanation for Austin's question, which was in-depth. So Melody, perhaps you could add your views before we tackle the last question from Titus.
You can see me well?
We can see you perfectly. We're assuming from your phone.
Yes, I had to switch one of those days when technology just doesn't accept. So since Wesley has looked at the market level performance, I'll be looking at the company level performance and what led to the companies, like the performance going down from 2015. So we can just start with the media. That's Nation Media and Standard Group. So they started facing headwinds when there was that shift from digital, the shift from traditional print to digital, as well as, remember those days we used to have analog TV, ile TV kona mgongo. So the switch from that to the digital TV as well. So there were new media houses coming up, also the prospects of pay TV that made access to international TV stations, which were previously inaccessible. So it means that Kenyans had like a wider variety of sources of entertainment as well. And because of this, you would see that it would translate to fewer billable hours to advertisers, as well as now because of the use of social media, media advertisement doesn't have the same monopolistic access it used to have before. So now, naturally, that's what led to newspapers struggling with distribution, as well as TV stations struggling with advertisements. So now they have been switching their strategies. We've seen now that they're monetizing their websites, as well as relaunching their digital websites and such. So another factor as well, that time, remember that there was quite a buzz about betting, and these betting companies were using media to advertise. Now, when they increased the taxes and like they reviewed the watershed hours, it also had a negative impact on advertisements and on the an advertisement revenue from the entertainment industry. So that watershed, you can't advertise like, let's say, beer and such stuff, remember. So, and then looking at another company, at River Mining, we saw that actually it's actually being liquidated, and it's going to delist from the NSE due to the failure of administrators to revive operations over the last 2 years. So it used to be the second biggest cement producer after Bamburi, though it defaulted on a loan from UBA, and now it went into administration. So looking back, the downturn started in 2015 after it started facing competition, increased borrowing, as well as margin pressures. There are also some regulatory changes in the market. It was in its Tanzania market, where the government banned importation of coal, which had an effect on the manufacturing costs as well as capacity utilization. So now looking at River Mining, these are some things that were unforeseen, like you couldn't see before, like this 2015 period. So another one is Mumias, but as you know, this one, the trouble started way before, and the troubles are still ongoing. So you can see that one is mostly due to a high wage bill, corporate governance issues, also interference from political sides, just non-generating income projects. That was the power generation and water bottling business that it had. So I think these are some of the things that pushed performance downwards. But as you can see, this one had started even before the 2013-2015 duration. KQ as well started sinking into debts and losses since 2013, mostly due to the high capital expenditure. That's a project Mawingu, where it was purchasing new planes. Poor investment decisions, adverse travel advisories. Remember that time there was some advisories from these developed countries warning tourists from coming to Kenya. Also, they had a fuel hedging policy that didn't pan out, and it actually costed the airline. So also now we know that a proposed law in parliament is seeking to consolidate its aviation business. So it's more going to nationalization. It's like it's reversing back from its privatization efforts from before. Agricultural companies, as Wesley said, during that time, there was the issue of the commodities market that had an issue, it went down. So that also brought down the prices as well as the performance of the companies. Also, erratic weather conditions, currency pressures, and low, as I said, low commodity prices. Everready is another one. It was generating profits. Sorry, I know there are many. I'm about to be done. Everready was generating profits 2012, 2013, though it started now incurring losses 2014, 2016. So around this time, there was an issue of stockouts as well as illegal imports of cheap batteries, as well as its court battle with Energizer. So you can see these are company specific as well as external factors that affected the performance of this company. Uchumi, that one started issues a long time ago. So this one, you could see it coming from before the 2013 period. And then Express Kenya, 2011, it lost its contract from DHL as well as other big clients. So this one, we can see that it started before the 2013-2015 period. So from then, somebody could kind of estimate and judge that this company is facing some headwinds. So the issue of cheap imports as well affected Samia Group. So also they had to close down their manufacturing plants. They actually got out of the tire business and they came back just recently. So we can see that just looking at those few companies, it's not possible to be able to foresee how a company is going to perform, though there can be indicators like if the corporate governance issues, that's where the issues of debt come about, poor management come about, and the performance of the companies actually goes down. But on the brighter side, we've seen that Safaricom has been on an upward trend since 2015 onwards. So there are many different factors that affect a company's performance. So I think those are the few company specific, and as Wesley has said, market specific factors that affected these companies. So some of them you can kind of foresee, but most of them, they are from unforeseen circumstances, like COVID now. We had no idea the effect it would have on the economy, and it was unforeseen. So yeah, that's it from my end.
As in, I am speechless, which rarely occurs. Melody and Wesley, thank you for that. Austin, if this was a question for an assignment in campus, we are taking a share of that grid, because I've never, I've never seen a question thoroughly researched. So I think also for all other attendees, if you have a question before Monday, feel free to reach out to us. You can tell that Wesley and Melody took time to actually look into Austin's question. So if you want an in-depth analysis, please feel free to do the same. Kudos, guys. And Austin also says thank you. Just two more questions before we call it a wrap. Titus is asking, what's your take on the near-term real estate sector performance? And I know in the Q&A, I saw someone who was concerned, I mean, not the Q&A, sorry, someone in the chat who was concerned about when local establishments in Kenya seem to fall one after another. Should we be worried? So he cites examples of Nakumatt, Tuskys, Intercon, and now transport companies. So maybe we could talk about real estate and the demise of some of these companies, although I feel like in a roundabout way.
Oh, let me tackle it. In a way, my professor gave it to me back in the campus days, which are not so far back.
But less verbose than the professor.
So there's this aspect that it's a norm out there that they say you can't know a bubble until it bursts, because in the same way, using the same analogy, you can't see a bubble until it bursts. You may call it a bluff and see it as a bubble, and maybe it's some momentum growth or something. So in the same way, as in, you really can't foretell the fall or the state of the corporates in how, let's say, it's not in a so good state, how will it go? Because down the line, you'll find something like NBV, for instance. It's my best case study. Everybody knew NBV, that's the last stock you need to think about in the bourse, because it's just been on the low. A shoe retailer, really, we don't expect much from them. Then Delta came across and everything changed. So you find even in this sector, like you've pointed, Tuskys, Nakumatt, Intercon, and now transport companies. Yeah, maybe there are company-specific and sector-specific issues facing the sector, but not in the larger view of economy. And given how the government pushes policies to such issues, we really don't know what will happen in the near future. So we can't give a permanent, or we can't, or I should say, I'm shy to give a permanent, a long-term view on a temporary, or on, well, the view is quite myopic in a sense. Melody, your high-level thinking, please.
Thank you, Wesley, for your insights. So for me, I believe the real estate sector, the outlook, it's going to depend on quite a number of factors, mostly how the economy is going to do in this current pandemic period. And also because of the perceived high risk of producers, they might have a constrained amount of financing that they can get. There's also the how can I put it? Let's say that a few of the drivers of this industry are going to be the affordable housing initiative. So once that kicks off, we might see some, you can say, progress in the real estate sector. Also the infrastructure development as well. We're going to see things like the bypasses, that you can see the road constructions going on, and it might draw people to develop certain areas. Also, just the gradual recovery of tourism. We've seen that people now are turning more towards Airbnbs. So I think that's another aspect to look into. But also, because of the reduced disposable income, as I say, because of the pandemic, we might see some the uptake of housing units a bit slower than the previous periods. Also, there's the issue of ineffectiveness of public-private partnerships of housing developments. So this may create an issue with the aspect of affordable housing projects. So we can say for now, as even CBK, they had said that it might take longer for the real estate market to rebound, but there is some progress. However, it may take some time. There was also a report that actually financial institutions are driving up occupancy levels in offices as people get back to normalization of their of their duties, more or less. But it's still a wait and see. I don't think it has recovered yet from the levels it was at in 2020, but it's a wait and see as these initiatives come along.
All right, guys, thank you for that response to Titus and to Frederick on their concerns. George had asked what was the email address to send in questions prior to our briefing. Marketing@genghis-capital.com. That email comes to me and my team, and then we liaise with Melody and Wesley. So yeah, keep these guys on their toes. I think that's great. Compliments from Joseph. He says a great analysis, guys. So I hope you guys receive your compliments wholeheartedly. There's a question from our Facebook Live, and with it, I think we should call our session to a close. Kelvin Waneki from Facebook is asking, what is the foreseen effect of Kenya's heavy foreign debt growth on the stock market in the foreseen future? Could we give him a brief answer, like a 1-minute answer, guys?
Sure, I can see that it's just the perceived risk that's going to cause an outflow from our markets, because it will get to a point many people will think that the government will go into financial distress, and that might lead to panic selling, like we saw that time for the 2007 elections during that time. So whenever there's an aspect of heightened risk, especially now with the way the shilling is performing, this loans might end up becoming more expensive in time, especially now if the rates, like we've seen that the LIBOR rates have been quite low, like the rates on the loans, if they go up, Kenya might find themselves having more debt costs to pay. So I think that heightened perception of risk might cause investors to be cautious, and they might decide to withdraw their funds and invest elsewhere.
Fantastic. Thank you so much. So with that, we have concluded the Q&A session for our Monday investor briefing. I'm happy to see that Ian joined us. So to all our attendees, please don't shy off from questions related to fixed income. Ian is our guy, and he's here with us along with Melody and Wesley. Wilson, thank you so much for your kind compliments, and everyone else as well. Thank you for joining us today. Let's meet next week. Is not a holiday, right? No, next week is still, no, I'm looking forward to the Huduma Day, right? I should do some research, or maybe you guys can do research for me, whether Huduma Day is a holiday and it's on Sunday, so that we'll have Monday off. But that aside, let's meet next week for another session of the Genghis Weekly Investor Briefing. We remain available to you across all our social media platforms, as well as on email, and we're always happy to engage with you and to continue the conversation. Thank you, Wesley and Melody. You guys outdid yourselves today and have raised the bar for next week. So I'm super excited to see that. So goodbye, everyone, and see you soon. Bye, guys.